Good morning. This is Ken Long from Tortoise Capital with a review of the weekend trading reports for November 16th, 2013. We're in a bullish normal market. On an annual basis, using weekly RSI 14, we've moved further into overbought conditions with 75 out of 100 is the score. On a 10-day basis, using the 10-day NDX, we're at 114 out of 100, so well overbought. In fact, the 114 means that we are 14% higher than the previous 10-day high on the basis of the 10-day trading range. By that I mean, if you took the previous 10-day trading range and took 14% of that, that's how much higher the market closed on Friday compared to the previous 10-day high. So that gives you an indication of the size of the breakout. Looking at the market mosaic, we are in white bullish with price respect to the 200-day moving average, 10.53% white bullish. That's an improvement over red bullish a couple weeks ago. Slope of the 50-day moving average has improved to 0.81%. Green bullish, that is extremely strong. ADX 14 at 24.8 is right on the boundary between neutral and strongly trending, with the bulls in charge. ATR percentage remains low at 0.81%. That's the low end of normal. The risk index is the 30-period moving average of the VIX divided by the 10-period moving average of the VIX. That number comes in at 1.10, which puts us into risk-on conditions. That's favorable for holding risky assets. If we take that score of 1.10 and compare it to the last 5,000 days, and then we take the z-score of that, which is how many standard deviations above or below average that is, that comes in a z-score of 1.21, which is more than a normal risk-on condition. But you can see on this time series of the last 90 days that we have been decaying from a z-score of 1.5 down to 1.21. About 60 days ago that happened, and this was a very good swing trade in VXX. And so we're going to be sensitive to market condition changing here, particularly when we just had a 10-day trading range breakout. So if that's a false breakout, we'd expect some sharp selling, and that would drive the volatility up. So we're going to be respectful of our stops to preserve profits while we are enjoying this bull market. This is a summary of the 2-day live trading workshop just completed in Raleigh, and we were looking at a combination of swing and day trading taken together so that each one supported the other. And this was over a 2-day period, and we took about 52 trades, you can see here. The maximum trade win was 3.9R. The worst loss was minus 0.8R. There were 27 winners, 9 scratches, 16 losses with a standard deviation of 0.83, an average trade of 0.35R, and an SQN at 3.09. That leads to a win rate of 51.9% for an average win of 0.92R, 17.3% scratched at 0 and paid for the round trip, and then 16 losses was a losing rate of 30.8% with a average R loss of minus 0.41. So it's a coin that pays off 2 to 1, a little better than 2 to 1, and we'll take that. This is a scatter plot of the trades by sequence. So trade 1 was here, that was a scratch. Trade 2 was a fractional win, and so forth. You can see there were a number of there were only 4 trades that were better than 1R, no trades worse than minus 1R. That gives a histogram that looks like this, which is what I look for in my own trading, which is a tightly controlled risk to the left side of 0, a normal distribution looking curve here that has plenty of wins between the 0 and the 2R, such that the region between minus 1 and plus 2 is positive expectancy, and then with the possibility of fat right tails, which can tilt the odds in our favor. The average rolling R of that trade system started off a little jumpy, as you would expect, and then it settled in around this 0.35 trading consistency, the expectancy of the system, and then this is what the rolling R, or the cumulative R of that trade set looks like after a couple days. So that just those characteristics are typical of what we get in the live trading workshops. This is just a quick look at the blended monthly rebalancing portfolios. I'm sorry, I skipped over a part on page 1. Let me go back to that. Sorry. What we're still holding now in blended monthly rebalancing is technology, Australia, small caps in the ETF 13. It's the NASDAQ, then U.S. industrials and basic materials in ETF 22, and ETF 32 it's NASDAQ, industrials, and then the BRICS, with the next reevaluation being on or about 1 December, and then the theoretical exposure in ETF 2 remains at 100%. The model portfolio is at 20%. Okay, now back to the blended monthlies. You can see right now in the ETF 13, only treasuries are on a cash signal, which is priced with respect to the 4-month moving average or the 88-day moving average. It's technology, small caps, mid caps, so it's the U.S. is back in a leadership position. Inside the ETF 32, it's industrials, consumer discretionary, and then technology. And you can see this is still U.S. dominating all the way down to position number 11. And so the U.S. is ascendant here, replacing Europe as the regional leader. In ETF Max, you discount the VIX. That should have been hidden there. The price quotes didn't get adjusted from Yahoo, so that's just a reverse 5-to-1 split. So discount that. The leaders remain 10. The solar ETF, another solar energy ETF, KWT, Golden Dragon Power Shares, Clean Energy, Clean Edge U.S. Liquid Energy, Internets, China Technology, Egypt, China Tech, China India, and so that's going to be good for EEB. That's in that ETF 32 portfolio, which includes both China and India. And this one is interesting here. The S&P Transportation ETF. Really odd to see that so strong, but that's a good sign for the kind of the basic production side of the economy when transports are doing well. Again, what I like to look for are those like the Vectors Gaming ETF that are strong on the 3-month return, in the green, in other words, compared to the rest of the ETF Max database, and then white on the 6-month percentage. And what that suggests is that their growth is a more recent phenomenon. That suggests that's what it actually means. And then conversely, those that are green on the 6-month percentage, but which are white on the 3-month, are showing some signs of losing some steam. And so I'd be concerned about social media, global wind, U.S. defense, Dow Jones U.S. broker dealers. Those are all ones that are showing some signs of weakness. And so you can see this this reading will show you sort of the opportunities for oversized gains and oversized growth going forward. Back to the market health check. You can see that we had a breakout from the 10-day trading range here on Friday. The dark blue shaded area is the river, the Bollinger Band 30 plus or minus 1. The lighter blue shaded area is the Bollinger Band 30 plus or minus 2, the floodplain. Those are the boundaries of normal moves, the absolute boundaries. Once it gets outside of the river, it's becoming exceptional. If it gets past the floodplain, it is really exceptional, like this area back here in late August, which was a signal for a potential reversal trade or a much greater breakdown trade, because as you can see, it happened here. Didn't even get to the Bollinger Band mean, to the middle of the river. got rejected at the edge of the river, had another crash down, but then had a nice long move all the way to the far side beyond the floodplain, which sets up this nice move in retrospect. So after a period of about 10 or 12 days of consolidation here between that 175 and 178, the market voted up on Friday, and it's now out into the floodplain. The blue channel is the 10-period RAF regression channel, and it's on the upside and it's pointing the way to about 185. The black channel is the 30-period RAF regression channel, with the center line being the regression line, and the outer channel is formed by the maximum excursion from the regression line during the look-back period, which in the 30 happened back here in early October. So once that point drops off, the channel is going to get much tighter here. But that's steeply sloping upwards. And so when the 10 is steeper up than 30 and the 30 is steeper up than the 90, which is this green channel, what you have is an acceleration of trend as we start looking closer and closer till tactical time, and that's a sign of expansion and potential upside moves. Of course, we're going to respect the possibility for a retracement on a false breakout, but right now it's all systems go. We're still in the floodplain, and that's good. The slope of the regression line over time is this sine wave looking black line. I've highlighted on the blue circles where that slope went positive and when it went negative. That's these circles here. It tells you basic shifts in market state. And then the blue circles here, here, and here are showing the extreme moves of slope. And I've highlighted this one especially right here, that after this peak right around the beginning of October and it started to decay, we would not have been surprised to see that slope line cross the zero and go negative and come down and test where that lower limit of minus 0.225 on the last time that it retraced. But instead of coming normally, you might say, back to that zero line and beyond, it actually reversed here because of this buying pressure, which then took out the previous high, and then that shift in market state is what's supporting this move here. And it started to decay once more at an upper limit where we drew this warning blue circle here. But the last 4 to 5 days have really voted upwards, and so now you can see the slope of that regression line stabilized and is now starting to expand upwards. So there's a potential for another upward leg starting really the same size of this move from 166 to 177, or about an 8% move. This upward expansion here supports the idea of another 5 to 8%, which could be $8, and thus we're thinking from 180 we could see 185, 190 on the basis of the technical indicators. You can see the 200 period moving average down here in the red shaded area is being left behind, and we've got about an 8% cushion from the current bull reading down to sideways market, which would be down around this 166. So it's looking like all systems go right now. You can see the ADX has leveled off at 25. It's just about to begin strong trending if we get another day or two of upward trend, and that ADX is going to tip above 25, and that's a positive sign for the beginning of strong trends on an intermediate basis, and that's my basis for believing in the potential for another 5 to 8% to the upside. On the downside, these red horizontal lines are price levels that have held as support before and would act as price targets. On any collapse in price from here, we would see the first target at 176, 75, 73, 170. If it violates 170, that one is really crucial because that's the bottom of the river. It would represent a 50% retracement in the previous leg up. It would have negated 2 previous swing highs. That would be signs of serious concern. So we've got about, in my judgment here, about $10 worth of wiggle room. I would start getting concerned at 176. I'm using that as the yellow zone from 180 to 176 as sort of the noise zone. I would expect if this market is going to work, the midpoint of this last 10 days, 177, would act as a support level as well. And so we'll see how things go in this week. Like looking at Williams percent R, we're overbought, have been for a while, but we can remain that way for a long time, as you've seen. And the jaws of PPO had just closed from the downside. You know, this big red price bar from last Thursday is essentially closed the door, or was opening the door to the possibilities of downward moves, and it was rejected on Friday, and then the follow-on of the whole week was positive. So the jaws to PPO have closed. They've just started to open to the upside, so let's see what we get this week. PPO has been a very good marker of intermediate trends, and it has given us opportunities to shift our position on market state in time to take advantage of it on swing trading. So with the jaws just starting to open to the upside, again, there's more technical evidence of a potential for upside moves. Looking at ETF2, the regional report. So right now the S&P, the U.S., is stronger than EFA, which is the rest of the world, on the basis of the strength column. So it's 51 in the S&P versus 49 in EFA. So that's why we say the U.S. is better than the globals right now. Last week, the S&P had fought its way back into a tie, and now it's moving out ahead of the Europeans and the Asians. Inside the U.S., the rankings are technology, then small caps, then large caps, then mid caps. And that, again, favors the risk-on trade with technology and small caps leading the way. They are also the two strongest sectors in the world, and the two weakest remain Latin America and Japan. And on market weakness, we would be expecting those to fill faster and further, and that would be targets for shorting. Inside the U.S. sector spiders, the strong ones are industrials and consumer discretionary, followed by healthcare and materials, and the weakest being the defensive plays like, it's utilities, and then financials are suffering too. Inside the world market model, again, starting with the U.S., you can see that it's all above average in the white, and then on the growth side, it's extremely above average in Asia. Japan and Asia, less Japan, are both above average, and the leaders in Asia are China, South Korea, and Australia. Mexico is lagging, Canada, Brazil above average. Everything European is above average. The leaders remain Germany and Spain, and only Sweden is lagging. Inside the other asset classes, the commodities, oil, gold, and silver complex are dragging. The alternate classes of treasuries, corporate bonds, U.S. real estate are below average. Private equity remains just slightly above average. Inside the business sectors, it's the U.S. generally in front of the global counterpart, with a couple exceptions like finance and technology. But the market is tilting over towards the U.S. and its strong business sectors right now, with industrials and consumer discretionary definitely leading the way. ETF top 30. This is similar to the blended monthly rebalancing. It used a slightly different set of computations, but it gets independent confirmation of solar, Golden Dragon, clean energy, pharmaceuticals, more pharmaceuticals. Again, we're looking for things that are green on the strength and white on consistency as new emerging leaders, and so that would give us insights into like PGP, which is green then white, and then the producer of durables index, FXR, green then white. Healthcare, Guru Holdings, whatever that is, and First Trust Energy, all those are green and white. S&P small cap growth starting to lead the way again. That's kind of an easy way to play a broad sector with IJT. That looks interesting. And let's see, looking at the Dow 30 and through the same lens, it's Boeing, Nike, Microsoft, GE. And the emerging leaders here are Microsoft, GE, Visa, 3M, and Pfizer, based on their green strength and white inconsistency. And these numbers, these shadings also come from a comparison of the Dow 30 against the 1,500 ETFs and ETF Max. So you can see where on an absolute basis these companies are performing. We have two in the losing stack here, Cisco and IBM. Cisco is a recent arrival here at the bottom of the stack, and it's kind of odd that with the strength in U.S. technology that Cisco is the worst performer in the Dow, so there may be a value play there or something that could be reinforced on weakness. If the market began to be weak and Cisco was really failing, that might be a short candidate there. Intel is relatively early in its outperformance of relative strength in that it is white on strength and then yellow on consistency, as are ExxonMobil and Procter & Gamble being white and yellow. That's a favorable sign. Whereas something like Goldman Sachs is weakening because it is yellow on strength and white on consistency. And that's how I use those two columns of strength and consistency to find some of the longer term trends and then relative opportunities inside the stack of the Dow. Just a quick look at the ETF liquidity report for the most heavily traded on the basis of average daily dollar volume and then their relative ATR percentage. So you like things like GDX that are very liquid and yet are also very volatile. Shifting now to the daily report, again we see the some of the same indicators, so I'll just go right to the ones that we haven't looked at yet. We have a short signal in ILF using the overreaction system, and so I would wait to see market weakness, and then I would look to Latin America as the potential short on that one, although the rule set allows you to short that at the open. You can see the decline in volatility over the last 100 days. We're in the low end of normal. You can see ADX starting to rise again at plus 25, with the bulls definitely in charge. Only a couple pattern trades, AT&T and Verizon on 551Ws, and then a handful that test out well on the auto framer at better than 2-to-1. You can see the 10-day min pain are going to be the ones that are in a leadership position for each of these four symbol populations. So in the Dow 30, ExxonMobil, Home Depot, Verizon, JP Morgan, and Nike. Only a couple dojis in the Dow 30 tactical, nothing fired on RSI 2. Cisco and ATT fire for the auto framer, so Cisco at 4.3-to-1 on the auto framer reward to risk, and then AT&T on a 2.6-to-1. In the ETF tactical summary, you have 5 symbols that test out well on the auto framer. VXX coming in also with a 3 on RSI2, and silver at 5.9-to-1, gold at 5.4-to-1, real estate at 3.5-to-1, and treasuries at 4.2-to-1. Bucking the trend, the one-day trend, Brazil and Latin America were both percent winners on Friday compared to their peers, along with Japan and XIV. And so that's either going to be a deep value play or it's going to be a dead cat bounce if we get market weakness and then that Latin America and Brazil sector begins to suffer. The good news is that they're very volatile and can support trading in either direction as they're both very liquid. Just the auto framer stats for those of you that are mechanically framing trades. And under the framing data, for example, you would find that the auto entry, the mechanical entry for VXX is at 47.47, and this would suggest a 52-cent risk based on using the high of the day plus a nickel to enter and the low of the day from Friday minus a nickel as your initial stop gives you a 52-cent risk with a target of 51.96 or the 10-day high. That comes in with a 8.63-to-1 reward to risk ratio, and so on. The 30-day regression line is the solid straight blue line here. The polynomial regression line is the black line. They're very close, meaning there's been very little volatility. You can see the time series of that here. The 10-period regression line has now caught up to its 10-day moving average at a distance greater than 1 standard deviation from the black line. That has always been a warning in the past of a potential state change in the market and a reversion to the mean. which would mean that Friday's move up was a potential false breakout, and that's why we're going to be concerned about where we are in the life cycle of this trend, and respect our downward, our profit preservation and capital preservation stops for our measured risk. And you can see on the percent stretch above the 200, we are just about one standard deviation above the 6-month normal. However, we do have two previous excursions that went higher, so that's why we are also potentially at the beginning of that next upward leg. So we are at what I consider to be a critical state in the market, because now we can frame a favorable reward to risk trade in either direction, which means that we would expect some increased trading activity and ready for a move in either direction with measured risk against measured reward is, in my view, the secret to long-term survival. The rest of these are just reference charts for your use. I'm not going to comment on them until we get to this one. This is the z-scores of 3 different regression line slopes, the 10, the 30, and the 90. And we're looking at the z-score of the slope, meaning that how steep up or down have these been compared to their own performances over the last 6 months, and then expressing that as how normal or exceptional that is on the basis of the numbers of standard deviations away from average. And so the thin blue line is the 10 period. It's just beginning to depart this plus or minus 1 range of normal. And so what that means is on a 10-day basis, this still has room to get much better, as it has the last 1, 2, 3, 4 out of 5 times that it tested this river boundary, if you will. And so that's the basis for another 5% move to the upside potential. The 30, however, has leveled off at something of an extreme area, and that's not a cause for concern yet. It can still get up to +2, but again, we've got a breakout, as you can see down here, with price respect to the river. And this last test only came to the edge of the river before starting. And the last time it did that, every time it actually when it came back to the edge of the river, it failed. So this is really kind of new territory, and that's why this could potentially be the next upside leg, or equally probably a false breakout and then a pullback that comes at least to the edge of the river, then the Bollinger Band mean, and then the bottom side of the river, where we would expect to hold on the basis of the bull market that we're in. The 90-period regression line, the last one, is this red line, and it is still in the range of normal, but it has been improving and getting better, but it's not overheated yet, and that's why, again, with the this stable base that was built over the last couple weeks, this could be the beginning of that next intermediate leg up, and that's the basis for believing in the possibility of 185 and 190 in the S&P. So I'm always cautious, but I'm bullish right now because of the failure to fail in the last 10 days, and so I'll be ready on that basis to continue to add to winners and be willing to hold those overnight with appropriate levels of risk, while simply just monitoring and adjusting my stops to reflect my risk tolerance. So up we go, I think. Just some quick stats on the frogs and the holding periods, just for your review. Some gap statistics, intraday range percentages for range stat purposes. And that's everything I want to cover for this weekend. So this is Ken Long from Tortoise Capital. Keep your risk measured and your powder dry.